Welcome to The Explainer. Today we're diving into the latest catastrophe bond market report from Artemis.bm. And let me tell you, the first half of 2025 has been absolutely historic. The insurance-linked securities market just had a run that completely shattered its own limits. So let's get right into the numbers. To put it simply, the cat bond market is on fire. I mean, the second quarter of 2025 wasn't just a strong quarter. It was a period that rewrote the entire record book. We're talking about a level of activity that has completely reset everyone's expectations for what this market is capable of.
So, let's start with the big one, the headline number. In just 3 months, the second quarter alone, new cat bond issuance hit a mind-blowing $10.5 billion. Now that is by far the biggest single quarter in the market's entire history. The old record was just over $8 billion, so this isn't just a step forward, it's a giant leap.
Okay, now let's zoom out and look at the whole first half of the year. When you take that record-shattering second quarter and add it to what was already a record-breaking first quarter, you get this: $17.6 billion. That's the total for just 6 months. It's a truly incredible number that shows just how much momentum and demand there is right now. And here's the stat that really puts it all into perspective. The previous record for a full year of issuance was about $17.7 billion. So in 2025, the market nearly hit that all-time annual record by the end of June. We've basically crammed a record year's worth of activity into half the time. The pace is just off the charts. So the big question is, who's behind all this explosive growth? Well, it's a really fascinating mix of brand new faces and the established giants. The sheer amount of capital being raised tells us that the market's appeal has never been broader. Let's take a look at the sponsors who are driving this thing. A huge part of the story is how much the market is expanding. A joint record 8 new sponsors showed up in the second quarter. And we're not talking about small toe-in-the-water deals either. Players like Utica National, the Texas Fair Plan, and Ocean Harbor collectively brought in over $1.16 billion in new risk. It's a clear signal that cat bonds are becoming a go-to tool for risk transfer.
But it wasn't just about the newcomers. At the exact same time, the market's most experienced, biggest players came back in a massive way. They were looking for more protection than ever, and they really pushed the boundaries of what a single deal could look like.
And this is where things get really wild. In May, Florida's Citizens Property Insurance hit the market with a $1.525 billion deal, the largest cat bond ever at the time. It was a huge moment, but that record only lasted a few weeks, because then insurance giant State Farm came in and secured an incredible $1.6 billion in a single shot, setting a new all-time high. I mean, to have 2 record-breaking deals of that size back-to-back, that's a massive vote of confidence from the biggest names in the game.
Okay, so we know who's issuing and for how much. But what kind of risk are we actually talking about here? Let's break down the bonds themselves to see what structures and perils are really driving the market.
First up, the trigger. Indemnity structures were just overwhelmingly dominant, making up 82% of all issuance. What that means is sponsors really want coverage that pays out based on their own actual losses, not some wider industry number. It's the cleanest, most direct form of reinsurance, and it just keeps getting more popular.
Now, what about the risks being covered? Well, the story here is all about the United States. A huge 74% of the capital raised was for U.S.-focused risks, especially named storms and hurricanes. And that makes perfect sense, right? Sponsors were locking in their protection right before the start of the Atlantic hurricane season. Even those international multi-peril deals, which were another 20%, often had U.S. risks bundled inside. This, of course, leads us to the billion-dollar question. With this massive flood of new bonds hitting the market, what on earth has happened to pricing? Has all this new supply watered down the returns for the investors putting up all this capital?
And the short answer is, yes, pricing has definitely softened. It's just basic supply and demand. When you have $10.5 billion of new bonds looking for a home in a single quarter, the spreads paid to investors are naturally going to come down from those really high peaks we saw a year or so ago.
You can see that trend so clearly here. In the second quarter of 2024, the average spread above the expected loss was a very juicy 7.26%. By the first quarter of this year, that dropped to 5.07%, and it ticked down just a little bit more this past quarter to 4.93%. So while the returns are still pretty healthy, the market is definitely tilted to be more favorable for the people buying the protection.
So if the returns are dropping, why is issuance exploding? It's a great question, and Brad Adderley from Appleby has some really good insight on this. He thinks that years and years of education are finally paying off. You have a much wider, more sophisticated group of investors who now get this asset class, they're comfortable with it, and they're willing to accept these new pricing levels, which in turn gives more sponsors the confidence to jump in. It really feels like the market is maturing.
So all of this, the record issuance, the new players, the changing prices, it's not just a busy quarter. It has fundamentally reshaped the entire catastrophe bond market. So let's look at the big picture and think about what this all means for the future.
The most direct result of this issuance boom is just the raw size of the market today. During the first half of the year, over $10 billion worth of old bonds matured and were paid back. But with $17.6 billion in new bonds coming in, the net effect is a massive expansion of the total capital in the market.
And that expansion has been dramatic. At the end of 2024, the total outstanding market was about $49.3 billion. Fast forward to June 30th of this year, and it has surged to $56.7 billion. That's a 15% jump in just 6 months. The market has never, ever been this big.
This incredible first half obviously leads to a very, very exciting question. With $17.6 billion already on the books, the market is just a stone's throw away from a huge milestone. Could 2025 be the first $20 billion year in history? The second half of the year is usually a bit quieter, but the momentum is just undeniable. And we'll just leave you with this final thought from Brad Adderley. When he was asked if the market could find the roughly $3 billion needed to break that $20 billion barrier, his answer was straight to the point. Yes, because I don't know what's going to stop the momentum. You know, after a half year that rewrote every record in the book, it's really hard to argue with him. It feels like the catastrophe bond market has truly entered a new era.